A very good morning to all the students. Today we will be starting our discussion on portfolio management. So students, on this topic of portfolio management, this will involve a lot of discussions on certain different definitions or certain different terminologies. So what I thought is first to discuss those terminologies or definitions and then to take ahead the questions part. Okay. So students, first of all, what do we exactly mean by a portfolio? A portfolio is exactly a combination of certain things. Now, in this case, since we are studying about securities, so a combination of securities which will result into some kind of a economic generation activity would be regarded as a portfolio. Now, how that which security and how much of that security will go in a portfolio is the real question that we will be trying to answer through this discussions. Okay, because every security is not same. Every security is different from the another security. Good morning, Shailesh, Mansha, Shruti. Good morning, everyone. So students, we will start our discussion from the security first. So here, the security or securities, whatever we can say, is actually referring to the instruments, to the financial instruments, let's say equity, bond, or any other thing. So to make a portfolio of these securities, we first need to understand two things. One is the return part. How much return are we getting on those securities? And the risk part. What is the risk being undertaken to get those returns for that security? And from our previous knowledge, we already know that standard deviation is called as risk, which we already discussed in the risk analysis in the advanced capital budgeting, right? So, so this standard deviation is equal to the risk that we undertake. So if we know that what is the return and what is the standard deviation, then we can probably do a good analysis in what a security would look like. And similarly, the return will be the mean, the central value, the average value. Okay. Tanisha, good morning. Suraj, good morning. Okay. So, as I said that for calculating return, we would be given some set of data in the question. Using that, we will calculate the return. Now that data can also be a historic one or it can be a futuristic one. Correct, students? By historical data, I mean that you would be given last 10 days performance of a equity share. Basis that you have to calculate the averages and hence that will be your best expected or let's say the expected return, which is also called as mean. In case of futuristic data, there will be use of probabilities. So the question will say that they estimate in future, there is a 10% probability that the return will be 5%. There is another 80% probability that the return will be 8%. And lastly, there is another 10% probability that the return will be 9%. So something like that, there will be a probability given for the futuristic data. Again, the for calculating mean on probabilities, we all know we will just multiply the probabilities as weights into the different observations. Correct. We will do a lot of questions today to understand the exact application of it. Now, students, even in risk also, there are two ways. If the historical data is given, the calculation of standard deviation will be done at that level. Correct. And if the futuristic data is given, then also using probabilities, the calculation can be done. So this all we have studied in our previous, capital budgeting sessions as well, wherein we have tried to calculate the standard deviation in a probability scenario. Correct. So all those calculations, all those understanding hold good in this case as well. Okay. Now, taking our discussion ahead, for risks, we have different types of factors. I mean, you would be curious to know that why there is a risk while there is a return in a security, but why there is a risk element? Because We have classified all those factors into two buckets, which will lead to risk. Okay, what are those two buckets? One is the macro factors and other one are the micro factors. Macro are those which are general in nature. Micro, which are those specific in nature. Okay. So general to the economy in which these companies are operating, specific to the company. Okay. Now we will discuss some of the examples, but macro is related to the entire environment in which that company is operating. This is also called as a systematic risk, and this is called as a unsystematic risk. Why systematic risk? Because this is because of the system. Okay. This is because of the system in which we operate, in which the company operates. Okay. Now, some of the examples of systematic risk will be interest rates. Now, the interest rates are going up or down, it will impact the securities return. And interest rates are always a macro factor because it's not a specific to any company. It is always for the entire economy. Similarly, any sort of market trend. Then also any sort of purchasing power or inflation related metrics. Because these things generally impact the entire operating companies in that economy. Some of the unsystematic risk or specific one is business. Now, what is business risk? Risk that whatever is delivered by the business will not be there in future, specific to that industry, specific to that company. Similarly, liquidity risk. So this business risk is also called as a going concern risk, right? Whether the business will be able to continue in its own shape and its own aspirations or not. Liquidity risk, whether the business will be able to serve all the debt repayments as well as interest repayments or any other liability repayments on time. So whether the liquidity is a question mark or not. So these are specifics to micro, specific or unsystematic risk. Inflation is a macro factor, Mancha. Okay. Now, students, let us take this discussion ahead. Okay. Further, we have also discussed that standard deviation and variance, right? All of you will recall variance is actually a square of standard deviation, correct? That's what we have understood. Now, there is a term which I'm introducing here, which is called as covariance. Okay. Now, hear me out properly, students. Now, what do you mean by covariance? Now, if X limited, we are calculating the variance with X limited, it is called as covariance. Okay. Where the mean is also X limited and the observation is also for X limited. And we are doing a square of that, right? In variance. So we are just trying to say that how much within X limited the variance is. While we talk about covariance, we say that what is the variance of X limited with regard to Y limited? So collectively, for these two companies, if X limited goes up, then what is the behavior in Y limited and how much it goes up or goes down? So what is the variance there? So collective variance of both of them is called as covariance. So collective variance is called as covariance. Okay, students. So X limited in relation to Y limited. This we also call as, let's say, joint variance, right? Whatever is the joint variance between X limited and Y limited. Now, since variance formula we already know, I'm just putting the covariance formula here. Covariance between x and y will be given as summation of this is the standard thing, right? So xi means for every ith observation, where I is equal to 1 to n, okay, the number of observations. So for all the ith observation minus calculating their deviation from the mean, which is x bar, which will be multiplied by y, I minus y bar. So for that particular observation, what is the y value and minus y bar whole divided by the number of observations. So had it been a regular variance formula, it would have been a square here, students. Please note. And there had been nothing. This would have been nothing, right? So only square and divided by n. That's all. But since this is a covariance, hence this formula has been made. I hope the formula is self-explanatory because in this, the x deviation will get multiplied with y deviation and hence there is a co-deviation. So the students, we discussed about historical data. If we are getting historical data. Now, if you are getting futuristic data, then covariance between x and y will have a use of probability, which will be, again, summation of all the observations from 1 to n, x minus x bar, y minus y bar, multiplied by the probability of the ith observation. Okay. So simple. Had it only be a variance, so we would have done only square and this would have not been there. Okay. But since this is a covariance, so variation of x with variation of y multiplied by the respective probability. Okay, students, I hope the covariance concept is clear. Now next, once we know that what do we mean by the covariance, we have to also understand correlation, coefficient, which is also called as R. This is very, very important metric, students. This is again a statistical denotion of what? This is perfectly negatively correlated. I will explain all this. Unrelated and perfectly positively correlated. So students, please hear. What do we mean by R? I think most of us would be knowing this is also called as a correlation coefficient. Correlation coefficient always ranges from -1 to 1 and it can be any value between -1 to 1. And what it will denote? It will denote whether the correlation between them is at 1. So if it denotes that the correlation coefficient is at 1, that means both the variables x and y are moving in the same direction and the degree of movement is also same. So let's say if x is moving by 10%, y will also move by 10% and in the same direction. Unrelated means there is no relation. X will move up or down 5, 10, 15, whatever, but y is also moving in a non-related direction. Similarly, negatively correlated will mean where r is equal to -1, where x is moving up by 10%, y will move down by 10%. Okay. So this is what the correlation coefficient is. So in a nutshell, we can say that So this actually talks about the degree of association. Okay. What is the degree of association? What if one variable moves in one direction by a certain amount, the other variable, how it will react? Now there is again a formula for this. If we have to calculate the correlation coefficient between x and y, then we will use covariance between x and y divided by standard deviation of x, standard deviation of y. And we can also rewrite this equation as standard deviation x, standard deviation y is equal to covariance x and y. Okay. So students, please remember these two equations. These are very simple equations and these will be used in a lot of questions. I hope the understanding is clear on our correlation coefficient, covariance, both of them. Okay, students. So what we are just trying to do, we are leveraging our previous knowledge on risk, on standard deviation, and we are making some minor changes to it to arrive at what it will fit in the portfolio. Okay. Now, students, let's talk about portfolios. Okay, till now we were discussing about the securities, their interdependencies, one security dependent to another security. Now let's talk about portfolio. So students, again, once we talk about portfolio, for us, there will be only two factors as of now. One is again the return and risk. Similar to what we have studied in the securities, right? Sorry, there is a return and there is a risk. Now, how will you calculate a return of a portfolio? What is portfolio? Portfolio is a combination of securities. So whatever are the individual security returns, they need to form up to a overall portfolio return. Okay, students. So portfolio return will be, again, since there will be different observations, summation of first to nth observation of the respective return multiplied by the respective weight. So xi will be return of individual security. Wi will be weight of that security. See, every security will have a weight in the portfolio, correct? And that weight will be in relation to the amount invested to the total portfolio amount, correct? We will actually discuss these through our questions. But formula is very simple. We just take the individual returns, multiply with the respective weights. Now, how you calculate a risk? Now, let's talk about risk, portfolio risk. So, students, there are two situations which we can say. One is a situation where two securities are involved, and second is more than two securities. So the way we have described to calculate risk, the portfolio risk, okay? Please remember, student, this is a portfolio risk. The way to calculate portfolio risk is described in two manner. One, let's take a case where there are only two securities in a portfolio, and let's take a case where there are more than two securities in a portfolio. So in this case, the risk of a portfolio will still be denoted by variance, correct? Variance of standard deviation. So the risk in a portfolio that is called as that will be equating to a variance will be equal to weight 1 square standard deviation of first securities square plus weight 2 square standard deviation of second security square Okay. Plus 2 weight 1, weight 2, standard deviation 1, standard deviation 2, and R1, 2. So here W1 is equal to weight of security, right? Similarly, W2 is also weight of security. Standard deviation 1, standard deviation 2 are the SDs of respective securities. R12 is equal to correlation coefficient that we just now studied between 1 and 2. Yes, Suraj. Suraj is asking in the previous formula that we have shown whether we have to first multiply then add. Yes. So Suraj, wherever this summation is written, so after that you have to perform all the operations and then you have to apply the summation part. Okay. Good morning, Viraj. Okay, students, I hope this formula is clear. Okay. Now, in this formula, if we see if R is equal to, sorry, R, the correlation coefficient between first and second, if is 1 or if it is -1. Okay. We are taking two examples. Then, so if R between 1 and 2 is equal to +1, and if you put it here +1, then this entire equation becomes A plus B whole square, right? A square plus B square plus 2AB, right? So then we can say that simply we can do like this to calculate the portfolio variance. Then there is no need to go to this level. Okay, to the entire formula, we don't need to go. And if R is equal to -1, then this formula becomes A minus B whole square. Because in this case, if you substitute R12 as -1, then this will be A square plus B square minus 2AB. Correct, students? So just remember this relationship as well. Okay, students? I hope this is clear. The two securities calculation. We will again do a lot of calculations to substantiate these propositions, okay? But just remember the discussion that we are doing, and this is a very logical flow of the sequence. Now let's come to more than two securities. So students, two securities were relatively easy because we had formulas. It's simply looking like A plus B whole square or A minus B whole square, or if it is not, R is not +1 or -1, something else, then we can use this formula which is mentioned here. But what if there are more than two securities? Let's take example of four securities. So in case of four securities, we have to go through a matrix approach. Okay, let me take three security example, because any which ways it will be same only, whether four or three, the approach will be same. Okay. So A, B, and then C. Similarly, A, B, and then C. Let me do one thing. Let me rewrite after leaving some space here. A, B, and C. Okay, these are the three securities. So what we have to do first of all, good morning, Viraj. Good morning, Ambika. So what we have to do first of all, we have to put it in a matrix. Okay, three securities are given in a portfolio, and we have to write their respective weights because securities will have a weight. Okay. So, see students, what we have to do while you are in the first cell A and A where it is crossing here. So you have to write W1, which is the weight one of this, okay, multiplied by standard deviation of A, which is again related to this. Then let's come to the column. In column, again, W1 standard deviation of A, correct? So respective weights and respective standard deviation first has to be multiplied. Then finally, we have to also take correlation coefficient between both of them, this A and this A. Okay. Now let's come to the second cell where there is a intersection of A in the row and B in the column. So what will happen here? W1 standard deviation of A, row is complete. Now let's come to column. W2 standard deviation of B, correct? W2 means weight 2, which is B's weight, and standard deviation of B multiplied by correlation coefficient between A and B. Simple. Then let's come to the last column, C column. Weight 1, standard deviation of A. Weight 3, standard deviation of C. Correlation coefficient between A and, correlation coefficient between A and C. And what you have to do, you have to take a addition and take a total after the end of the row. Similarly, here, weight 2, standard deviation of B. Then let's come to the column. So column will be weight 1, standard deviation of A, and correlation coefficient between A and B. Now, the next intersection will be B and B, right? So it will be weight 2, standard deviation B, weight 2, standard deviation B, R between B and B. Sorry. So now some of you might be thinking, what is the R? Correlation coefficient between B and B, which is 1. R between A and A will be 1 because there will be no correlation coefficient between a same security. It will be always 1. Weight 2 multiplied by standard deviation of B, weight 3 standard deviation of C are B and C. I hope it is clear. And then similarly, the numbers will be put. Then 1 we will take a column total and then all total. So all these 9 values put together, 1, 2, 3, 4, 5, 6, 7, 8, 9. All these 9 values, if you put together, then you will arrive at the overall portfolio variance. I hope students till now we are clear. All of you are clear. If there are any doubts till now, please do ask. Then we will go to the questions. Please, students, let me know if the discussion is clear till now so that we can move ahead and start with some of the questions. Yes, Kusuma, we will do the questions now. Sorry, Kusuma, I think you are saying we need to do sum at last. Yes, Kusuma, we have to do the summation of row and then column, or column and then row. We will have to just add all these values. Okay. Now, students, if you see, this is a matrix of 3 securities. Similarly, can you create a matrix of 4 securities? Yes. You just need to know what are the weights. You just need to know what are the standard deviation. And then you just need to know what are their correlation coefficients. No, Shruti. See, Shruti is saying that why are we not using BC whole cube? See, it will be true for 3 securities. But what about 4 securities, Shruti? So the whole cube will not be successful in a four security scenario. Hence, this approach is useful in all the approaches. Even I can tell you, Shruti, this matrix approach can also be used in two securities. So in case you don't want to remember this formula, okay, you can just apply this A, B, that's all. And you will find that the result is exactly same. So the method of metrics that we have just now discussed is a universal method. Okay. RAB is equal to RBA, both are same. Yes, Mansha. So RAB is equal to RBA. This is all same. One and the same thing. Ambika is saying we must consider weight 1 square, SD 1 square of each combination. No, Ambika. See, you should not consider while putting here, but automatically it will take if the second value is also A. So if you solve for this, this will be weight 1 square, standard deviation of A square, and RAA is 1. So it is 1. That's all. So this becomes this while you make it simple. Okay. But at the initial level, you will have to take the respective values. You cannot take the square. Okay, students. And there is one last thing that is left here. There is one last thing left here, which is we already knew that what is the relationship between covariance and R. So covariance and standard deviation, sorry, the correlation coefficient and standard deviation of the respective, uh, let's say, series will give us the covariance. So if we want to simplify, can we rewrite this as, can we rewrite this as, so R is given here and these are the standard deviations, right? So covariance AA multiplied by W1, W2. Similarly here, covariance AB multiplied by W1, W2. This is a simplified version, right? Similarly here, covariance A and C, W1 and W3. Okay, students. So this can also be represented in this manner. Shruti, in this matrix, would minus sign apply if it is applicable? Yes, Shruti. In case, let's say the weights are in minus, because we will see some of the questions, somewhere you will see the weights are also given in minus. So in that case, we will have to take the minus. But between all these values, we have to take a summation. Okay. So automatically that minus will come in the weight. That we will see once. Students, let's come to question number 1. So let me just briefly, sum up whatever we have discussed till now, because now we will be doing some of the questions and then we will again be coming to some of the concepts later on. So students, we discussed that in a portfolio, we have to be careful about the risk and returns of a securities, because securities are what they constitute a portfolio. Okay. And while we have already known what is the risk and what is the return in our previous understanding, mean and standard deviation, right? But we have to be careful about whether the data that is given in question is a futuristic or a historical data. Accordingly, we will apply the formula. Then we introduced the concept of covariance. Using covariance, we arrived at correlation coefficient, and using correlation coefficient, we arrived at more than two securities and two securities portfolio return and risk. Okay. Portfolio return is easy, but portfolio risk is a bit technical one. So students, let's understand these questions. So question number 1, students, X company limited invested on 1/4/2009 in certain equity shares as below. So we will just try to, point out the important data points. So there are two companies, M and N, and they have invested 1,000 shares of rupees 100 each, but the cost is different, 2 lakh rupees. So it would have been 1 lakh, which is, I am assuming the face value, but the cost that they have given is already 2 lakh rupees. Similarly, here 500 into 10 each, which is 5,000. And here it is 1,50,000. In September 2009, which is halfway in the year, 10% dividend was paid out by M Limited. And in October 2009, which is just 1 month after, 30% dividend was paid out by N Limited. So they have paid how much dividend? 10%. And they have paid how much dividend? 30%. Now, students, please note, mostly the companies pay dividend. The companies pay dividend on their face value, right? Yes, Shruti, that will be taken care of, Shruti. Mansha is saying covariance between A and A means covariance between A and means variance of A. Okay, because if you substitute the covariance of A and A in the covariance formula, you will find that it is exactly equal to the variance. Okay, perfect, students. Please be with me now. On 31st March 2010, market quotations showed a value of 220 and 290 per share for M Limited and N Limited respectively. Okay. So now there is a, I mean, if you, so we can just see that what are the relevant data points. So they are saying in the beginning of the year, you invested some amount, then during the year, there was some dividend paid out. And at the end of the year, what is the value per share for both M Limited and N Limited? This is a very good data point that we can use. On 1st for 2010, which is exactly after 1 year when this investment has happened, investment advisors indicate that the dividends from M Limited and N Limited, okay, dividends from M Limited and N Limited for the year ending 31st March 2011 are likely to be, this is a futuristic data, correct? 20% and 30% respectively. And that the probabilities of market quotations on 31st March 2011 are as below. So one, they have given us that what is the likely dividend, and second, they are giving us what is the likely price along with the respective probabilities. There are different prices and different probability factors for them. You are required to calculate the average return from the portfolio for the year ended 31st of March 2010. And this is a historical data because already that 1 year has happened, and in that we know what has certainly happened, which is 30% dividend and 10% dividend and 220 and 290 per share. However, in the second part, they are asking us to calculate the expected average return from the portfolio for the year 10-11, which is the next year to come. So this is based on futuristic data. And hence there are probabilities given for the next year, right, students? Then lastly, it is also asking us to advise X company limited the comparative risks in two investments by calculating the standard deviation in each case. So this is a very wonderful question because this will help us in revising all our formulas and everything. So first of all, we will start with our solution and we will calculate our actual return, right? Calculation of return of portfolio. And see, students, it is asking us to calculate the portfolio return, right? For calculating the portfolio return, we need to know what is the security returns, right? Calculation of return of portfolio for year ended 31st March 2010. Okay. So let's take two columns, one for M Limited and another one for N Limited. So students, dividend received is how much? So dividend received is 10% for M Limited on a face value of 100 rupees. And N limited is 30% on a face value of how much? I think 10 rupees. So 10% into 100 is 10 rupees. And here it is 3 rupees. Yes, Shruti, average return. Average return is this, which is what we are solving for. Okay. Then, so if you see what are the returns in a security, one is dividend and second is the capital appreciation, right? So we will have to also calculate the capital appreciation. So students, what is the cost of investment? The cost of investment here in this case is 2 lakh divided by 10 and 1,50,000 divided by 500. 2 lakh divided by how many shares we have purchased? 1,000. So which is 200 in case of M, and in case of N, 1,50,000 divided by 500. 500 are the number of shares, correct? So 150 divided by 500 is 300. Correct, students? So M limited share they have purchased at 200, N limited share they have purchased at 300. Now the price on 31st March 2010 is how much? For M limited it was 220 and N limited it was 290. 220 and 290. So gain slash loss will be 20 rupees for M and 290 minus 300, which is minus 10 for N limited. Overall yield, okay, which will be dividend plus gain slash loss, correct? So dividend was how much? 10. 10 plus 20. 10 plus 20 is 30. And here it will be 3 minus 10 will be minus 7. Okay. Then we have to calculate the return percentage, right? So the return percentage is calculated as absolute return divided by the original cost. Original cost was how much? We just now have calculated 200 and 300. So on an investment of 200, we made it 30 rupees from M Limited, and an investment of 300, we lost 7 rupees in case of N Limited. Okay, students. So we have to calculate the percentage return. So 30 divided by 200 30 divided by 200 is 15%, and in case of N Limited, minus 7 divided by 300 is 2.33 percentage negative. Okay. Now, the weights of securities. Now, students, till now we have calculated the individual returns. Now, we also need to calculate what is the weight of those returns. Now, see, students. For M Limited and N Limited, how we will be calculating the weights? What is the cost that we have invested in case of M Limited? 2 lakhs. What is the total portfolio value? 2 lakh plus 150,000, right? Similarly, for N Limited, we have invested 1,50,000 and the overall portfolio value is 2 lakh plus 1,50,000. Okay, students. So this actually becomes, I'm writing here 57% and 43%. These are the weights. I hope, students, this is clear. Please let me know if you guys are there with me. And then portfolio return comes as 57 into 15 plus 43% into minus 2.33%. So this comes out as 7.55%. And this is a return for which the year has already gone. I hope we are clear till now, students. Perfect. Thank you, Kusuma. So first part is done. Then let's come to the second part. Calculation of expected return for the year 31st March 2011. Okay, again, we will say M and N. So first of all, what is the expected dividend? That is given easily in the question. So the expected dividend is how much? 20% and 35%. Correct, students? 20% and 35%. So for M and for N, 20% on again 100 rupees, which is 20 rupees, 35% on what was the face value? Sorry, 50 rupees, right? No, sorry, 10 rupees. So 35% on 10, which is 3.5. Now let's also calculate the capital appreciation. So for calculating capital appreciation, we need to know what would be our closing price as on 31st of March 2011 would be. Closing price on 31st March 11. How we will calculate? Simple. We have been given different probabilities and different prices. So we will just multiply the respective probabilities into the prices. Okay. Let me just put here prob M and N. What is the probability? Okay. Or else what we can do is we can just simply multiply and put the values here. Let's first calculate for M. So 220 has a probability of 20%. 250 has a probability of 50%. Then lastly, 280 has a probability of 30%. Correct? And one more thing, if we straight away reduce the opening of 1st April 2010, we will get the capital appreciation. Okay. So students, please note we are reducing 220 here, not 200, because 200 was for first year. Now for second year, the opening becomes 220, which is the closing price of first year. Similarly, for N Limited, it will be 290 multiplied by 20% plus 310 multiplied by 50% plus 330 multiplied by 30%. What was the opening? 290. Correct? That was 290. So if we solve for this, I'm just putting the numbers here. For M and N, M we get 33 rupees as capital appreciation and 22 rupees as capital appreciation. Now the overall return, overall yield will be 33 plus dividend, which is 33 plus 20, 53. And here it will be 22 plus 3.5, which is 25.5. Okay, then the market value, or let's say the cost slash market value on 31st October 2000, sorry, first 31st March 2010 was how much? 220 and 290. Simple. So we will arrive at the returns now. Okay, student, this is the value. So the percentage return will be 53 divided by 220, which is equal to 24.09%. And similarly, 25.5 divided by 290, which is 8.79%. So the weights will be calculated how? So you had 1000 shares at the rate of 220 as the opening for M Limited, and for N Limited, we had 500 shares at the rate of 290. Correct? So weight for M and N will be 2,20,000 divided by 3,65,000, which is the total of these two. And this will be 1,45,000 divided by 3,65,000. So this is 39.7 percentage, and this will be 24.09 percentage. Sorry, 60 point, I'm sorry. This will be 60.3 percentage. Okay. So the overall portfolio return will be weights multiplied by the probabilities, correct? So which is 24.09 percentage multiplied by 60.3 percentage plus 39.7 percentage into 8.79 percentage. So this becomes 18.02 percentage. I hope students it is clear. So Shruti is asking, why are we reducing 220 and 290 probabilities given as on 31st of March 2011? Okay. So Shruti, since we have to calculate the capital appreciation, so we have to reduce the opening value, opening price, right? Because this will give us the closing price. As I mentioned, closing price is only given in this brackets, but while calculating the capital appreciation, we will reduce the opening value. Okay. Okay, students, let's come to the third part now. So in the third part, they are asking us to calculate the risk, which is the standard deviation, but for both the securities differently. Okay. Now let's calculate the standard deviation. Calculation of risk. We call it as standard deviation. So students, if you see, standard deviation would be calculated for futuristic data in this case, because there are different observations for that. So what are they? Expect. So first we will calculate for M limited. Okay, students. So expected price is how much? There are three cases that have been given: 220, 250, and 280. Then we also have expected gain. What are those gains? So 220 minus 220, which will be 0. 250 minus 220, which is 30 rupees. 280 minus 220, which is 50 rupees. Okay. Sorry, 280 minus 220 is 60 rupees. Then dividend is common, 20, 20, 20. Expected yield overall will be 20, 30 plus 20, 50, 60 plus 20, 80. Okay, students, this is the total yield that we have calculated. What is the probability here? I think it was 20%, then 50%, then 30%, right? So now probability multiplied with the expected yield overall. So 20 into 0.2, which is 4. 50 into 0.5, which is 25. And similarly, lastly, it is 24. So overall, we are having a expected yield of 53 rupees. Now we have to calculate the deviation, right? So x minus x bar, and then we will have to do square of x minus x bar. Okay, students. So what is x minus x bar? 53 minus 20 minus 33. Then again, 53 minus 50, this one 50, right? So it is minus 3. 53 minus 80, which is 27. In the next step, we will just do square multiplied by the probability. Correct, students? So we will do square of this deviation multiply with the probability. So I'm just writing here minus 33 square into 0.20. Then minus 3 square into 0.50. 27 square multiplied by 0.30, and let's take a total here. So the standard deviation becomes 21. Okay, students. Similarly for N limited, price, capital yield, dividend yield, and then total yield. Correct. These things will remain common. What were the prices? 290, 310, and 330. Okay. The capital yield will be calculated as the 290 minus opening price as on 31st of March 2010, which is 0 in this case. In this case, it is 20, and lastly, it is 40. Dividend yield is how much? It will be remaining same in all the cases, 3.5, 3.5, 3.5. Just take a total yield. Total yield will be 3.5, 23.5, 43.5. Then probability, we all knew, given in the question. Then simply take probability multiplied by yield. This will give us the expected yield, right? Expected yield 7, 11.75 and 13.05. Probability multiplied by total yield. Okay, students. So this gives us 25.5. Actually, this is the same value that we have calculated above. So see, students, 53 and 25.5 is the same value that we have calculated here. Okay. So because we are just doing the flow of standard deviation and hence we have just calculated in that manner. Now deviation, then simply deviation into probability, the last column. The deviation will be 3.5 minus 25.5, which is minus 22. Then 23.5 minus 25.5, which is minus 2. Then 18 similarly. And here will be square multiplied by the respective probabilities. 18 square multiplied by 0.30. The total number here comes as 196. So the standard deviation is 196 square root, which comes as 14. So the standard deviation of n is 14 and m is 21. Okay, students, I hope till now all the things are clear. Please do let me know in case something is not clear. So lastly, students, we will just compare the standard deviation of m and n. M was 21 and it was 14. So can we say that M Limited's investment in M Limited is more risky? We have to word it right. Investment in M Limited's share is more risky. Correct, students? Because the standard deviation is high. If the standard deviation is high, the the risk is also high. Okay, let's move to the next question, students. Question number 2. Ramesh has identified stocks of two companies A and B having good investment potential. Following data is available for these stocks. So they have given us the historical returns, right, from 2013 till 2019. You're required to calculate the risk and return by investing in stock A and B both. The risk and return by investing in a portfolio of these stocks. If we invest in stock A and B in the proportion of 6 is to 4, okay, so they are saying that the next part, they will ask us to calculate the portfolio return and risk 60 is to 40, the better opportunity for investment. Okay, students. So let us calculate the risk and return first. Okay. Calculation of risk and return. Let's take the first security first. Okay, students. For A, let's calculate. So first of all, we will put years, then market price, then return percentage, and then deviation of such return. So we will see how we calculate. Okay, so first let's put all the years. So students, please note this is a portion on the historical data, right? So this is a good practice on the historical data. Now futuristic, we did one question to understand the futuristic calculation. 2013, 14, 15, 16, 17, 18, and 19. Okay, the market prices of A Limited are what? 19.60, 18.75, 33.42, 42.64, 43.25, 44.60, and 34.75. Okay, students. So the return for 2013 we cannot calculate because we don't have the opening. So the return for 2014 will be 18.75 minus 19.6 divided by 19.6, which is the closing minus opening divided by the opening. So just note here, students, return is closing price plus dividend in case it is there minus opening price divided by opening price minus 1. Okay, students, this is the return that is calculated. Okay. Now see, students, first year there is no return, then second year minus 4.34 percentage. Similarly, next year it will be 33.42 minus 18.75 divided by 18.75. That will give us 2015 return, which is 78.24, then 27.59, then 1.49, 3.12, and lastly minus 22.09. So in case of historical data, we just take all the additions and divide it by the number of observations. So we will just take a total here. So the total here will be, just a second, students, let me do one thing. Yes. So the total here is 83.95. So the average return, which we can also say A bar is the mean, right? Will be 83.95 divided by 1, 2, 3, 4, 5, 6. 6 observations, which is 13.99, correct? Okay, students. So in case of historical data, we just divided by the number of observations. Now let's come to the deviation. So the deviation will be A minus A bar. Okay. First case, nothing. Second case will be 13.99. So minus 4.34 minus 13.99. Sorry. 78.24 minus 13.99. 64.25. Similarly, 13.60 minus 12.56 minus 10.87 and minus 36.08. Okay. Then we will just do a square of A minus A bar square. Okay. So 18.33 minus 18.33 square will be 335.9889. 4128.0625, 184.96, 157.7536, 118.1569. We are just simply doing the square, right? 1301.7664. The total here comes out as 6226.6883. Again, this total we will divide by the number of observations to arrive at the variance, right? So the variance will be 6226.6883 divided by 6, which is actually equal to 1037.7814, and the standard deviation will be square of 1037.7814. This will be equal to 32.2146. Okay, students, this we have calculated for A's return. Now we have to come across the B's return. So let me do one thing, students. I mean, the calculation format, everything is same, only it's just that the numbers are different. I'm just putting here the final outcomes. Okay. I request all of you to try this calculations later on. For B, the average return is actually coming out to be 97.14 divided by 6, which is equal to 16.19. Okay. Then variance is coming out to be 3582.1748 divided by 6. And similarly, standard deviation will be square of this value, 24.4342. Okay, students, I request to do the entire calculations. You will finally arrive at these values. These are very calculation intensive questions, and hence I request to please go through the same calculation that we have done for A. Okay. So now, students, the risk and return for both A and B, we can put return, risk. What was the return for A? 13.99%. What is the return of B? 16.19%, right? Then, sorry, I've put it the wrong cell. It will be here, 16.19 percentage. What is the risk of A? Risk of A is 32.2146. And the risk of B is actually 24.4342, which is the standard deviation. Okay. Yes. I hope the calculation is clear till here. The first part we are able to solve, which is the risk and return in that particular securities of A and B. Now let's go to the question again. The risk and return by investing in a portfolio of these stocks, if we invest in stock A and B in the proportion of 6:4. Now, students, here comes the issue, because in this case, we need to know what is the correlation coefficient between A and B. Then only we will be able to calculate the two stocks portfolio risk, right? So let's first of all calculate the For second, calculation of covariance between A and B. Okay, students. Here, again, I'm putting 13, 14, 15, 16, 17, 18, and 19. Okay. So we will just take A minus A bar, and here it was B minus B bar. So the respective deviations we will take. So A minus A bar we have already taken above. In the above table, if we see, this is the A minus A bar, right? So we'll just copy this. Minus 18.33, 64.25, 13.60, minus 12.56, 10.87. Sorry, actually, it should be 1 year below. I'm sorry. Because 2013, there is no value itself. 64.25, 13.60, minus 12.56, minus 10.87, minus 36.08. And similarly, B minus B bar, which is the deviation for B, this would have come by reducing the average mean from the respective observations. So this is for 2014 year, it comes as 30.94, 10.37, minus 3.54, minus 30.71, 31.25, and 24.19. And we will just multiply this 30.94 multiplied by 18.33. This multiplied by this. Okay. So this is actually A minus A bar, B minus B bar, right? This is what we need for covariance. So this comes as minus 567.13, 666.27, minus 48.14, 385.72, 339.69, and minus 872.78. So the total comes as minus 96.371. So the covariance between A and B will be given by minus 96.38 divided by 6, which is the number of observations, right? So minus 16.06. So now, students, can we calculate the portfolio return? Yes. 60% plus 40%, 60%, the return of A is how much? 13.99. 40%, the return of B is how much? 16.19%. So the portfolio return comes out to be 14.87%. Similarly, portfolio risk, we can calculate by this formula, right? Which was weight 1 square, which is 60% square, multiplied by standard deviation of A square, which was how much? That means the variance of A, right? Which was 1037.7814 plus weight of B square. which is how much? 0.4. Variance of B, 597.0291. Then it was plus 2, weight 1, weight 2, standard deviation of A, standard deviation of B, and correlation coefficient of A and B. So what we are just doing, because we have calculated the covariance here, so we are substituting formula using that into covariance, which was 16.06. So students, please note that we have made use of covariance A and B is equal to RAB, standard deviation of A, standard deviation of B. So we have studied our two securities formula in this manner and we have substituted with this. So hence it is 2 weight 1 weight 2 into covariance directly. Okay. So if we solve above equation, so the port, or I can say portfolio variance comes out to be 21.404806. Okay, students. So this is our portfolio risk. Now, I think the last part of the question is asking us to tell us the better opportunity for investment. Now, students, if you see their individual risks are how much? The securities individual risks are higher. In this case, it is 32 and 24. However, the portfolio at 60/40 comes at 21.4.06. Now, why this has happened? Because there is a negative correlation between both of them. If you see, the covariance between A and B is negative 16.06. So if you make a portfolio between these two, it will help in reducing the risk. Right. So this again we will discuss in our second part of the session today, which is the relationship of how two securities will help us in reducing the risk of a portfolio. But as far as this question is concerned, we can just simply say that since return is higher in B on the basis of return, B is preferred as B is having a higher return. And on the basis of risk, portfolio is preferred. Why? Because portfolio has the lowest risk. What is the return of portfolio? Return of portfolio is lesser than the return of B, and hence on the basis of return, B is preferred. On the basis of risk, portfolio is preferred. A is not nowhere a specific choice because A is having a lower return and higher risk. Okay, students. So students, I understand these questions are a bit, detailed and large in nature. Plus, these requires a lot of calculation intensity. But please don't lose the track because the concept is very easy and the question has to go in that flow. Okay. So it's 8:24 now, students. Let's take a 10 minutes break. We will again reconvene at 8:34. Let's go to the next question, question number 3, before we go to the new topic. Okay. Any questions till now, students? Please do post so that I can know. Or if let's say all is clear, then please let me know whether the things are clear to you or not. So question number 3, students, it states that a company has a choice of investments between several different equity oriented mutual funds. Okay. Now, please don't get confused with this term equity oriented mutual funds. These are those mutual funds which invest mostly in equity. Hence, they are equity oriented mutual funds. The company has an amount of rupees 1 lakh to invest. The details of the mutual fund are as follows. There are 5 different mutual funds. They have 5 different betas with them. Now, students, we have not discussed anything about beta, but we will discuss it subsequently. But beta is something that has a basically measure that is used to measure a change in some, let's say, A, B, C, D, or E, whatever these mutual funds are in relation to market. So it's a sensitivity of the changes to the returns, okay, when compared to the market. But we will develop the complete understanding later on. Plan 1, if the company invests 20% of its investment in each of the first two mutual funds A and B and balance equal amounts in the mutual funds C, D, and E, what is the beta of the portfolio? Okay. So students, without having any knowledge on beta, let's try to attempt this question, because see what will beta be? Beta of a portfolio will just be a weighted average summation of the respective betas. Simple. This is plan 1. Plan 2, if the company invests 15% C, 15% A, like this, and balance another 2, what is the beta of the portfolio? This is also very simple. Lastly, if the expected return of the market portfolio is 12% at a beta factor of 1, what will be the expected return on the portfolio in both the plans given above? Students, please make a note of it. The beta here mentioned here is same that we use in CAPM, capital asset pricing model. Okay. So the question is relatively simpler, wherein we can understand about the beta, how the portfolio beta is arrived at. So solution for plan 1. Plan 1, we are saying that 20% will be invested in the first two mutual funds A and B, and equal amounts in the mutual funds C, D, and E. Okay, so let's put like this: mutual funds A, B, C, D, and E. What is the proportion of funds? So 20%, 20%, right? 40 is this much. Then balance is how much? 60. 60 is equally, so which is again 20, 20, and 20. So coincidentally, it is 20% all across. Beta, respective beta is, sorry, 1.5 for the first one. 1, 0.80, 2, and 0.70. Proportion multiplied by beta. Okay, students? This is simple and easy, right? 0.2 into 1.5. Like that, we will have to multiply 0.30, 0.20, 0.16, 0.40, and 0.14. So the total is 1.20. So the portfolio beta for first plan comes out as 1.2. Okay, students? Then similarly, for plan 2, how we will be calculating the portfolio beta? Again, we will have to put all the mutual funds along with the proportion beta and weighted beta. A, B, C, D, and E. Five mutual funds are there. Now, what is the proportion? If you see, students, question is saying if the company invests 15% of its investment in C, so C is 15, A is also 15, 10 is in E. The balance amount in equal in other two mutual funds. Simple. So we will put whatever is given to us first, 15. Then C was also 15 and E was 10. So this is 40 in totality. Balance is 60. So B and D will enjoy equal amount of 60, which is 30 and 30. All makes it as 1. Then beta we will have to just put 1.50, 1, 0.80, 2, and 0.70. We will just multiply the proportion into beta to arrive at the weighted beta. So this comes as 0.225, 0.3, 0.12, 0.6, and 0.07. The total comes as 1.315. So in this case, the portfolio beta is 1.315. Now, students, there is another data point that has been given. If the expected return of the market portfolio is 12% at a beta factor of 1. So when beta is equal to 1, market is giving you 12%. What will be the expected return on the portfolios in both the plans given above? So we will just multiply it with the respective betas. So can we say that expected return is equal to beta multiplied by the market return? Because market return is at 1 and portfolio beta, we know that it is at the respective values. So plan 1 and plan 2. Plan 1, 12% is the market return. What is the beta in first plan? 1.2. And the beta in the second case is how much? 1.315. So this is equal to 14.40, 15.78. So this comes as expected return. Both of them are the expected returns in the different scenarios. Okay. Students, is this clear till now? Then we will move on to explaining the exact beta concept. Please do let me know in case anything is to be explained or discussed. Should we move ahead? Okay, so let's take the total risk discussion ahead. In the total risk, we said that there are two different kinds. Sorry. One is systematic and second one is unsystematic. So systematic risk, we said that it is a macro risk because of the macro factors and unsystematic is because of the micro factors, right? Now, students, we cannot do anything about systematic risk. Systematic risk will always be there. Only thing is by creating a portfolio, we can reduce the unsystematic risk, which is because of the diversification, right? So if a industry is having a specific risk, there is another industry which can give you a potential upside against that risk. So if you combine all those industries put together, so at an overall level, there will not be any unsystematic risk that will be left. There will not be any business specific risk. All the things that will be left will be systematic risk, which is only at a macro level. Now, beta is a measure that helps in assessing systematic risk. Okay, so what it will say, let's say X Limited, how sensitive it is to the market. So this sensitiveness is given by beta. Okay, students. But please make sure or please understand beta is not equal to systematic risk. Okay. While most of us gets confused, please note that beta is not equal to systematic risk. It helps in calculating the systematic risk. Okay. And in the layman's language, it is helping us to calculate the sensitivity of returns of X Limited in relation to the market. Okay. That is what is called as beta. Now, there are two ways to calculate beta. One is through correlation and second is through regression. Okay, students, one is through correlation and second is through regression. So in case of correlation, there is a use of covariance, there is a use of R, which is correlation coefficient, right? And the two variables here, one is X Limited and one is market. X Limited is the company for which we are calculating the beta. Okay, so we will study the changes in both of them. So if X Limited goes up, how market reacts? If X Limited goes down, how market reacts? If we do that study, we do that correlation discussion, then we will be able to arrive at the beta value. So in this case, the beta is equal to correlation coefficient between X and market multiplied by the standard deviation of X divided by standard deviation of market. This is the formula that is given for beta. Okay. In case of regression, again, there are two variables, but one is a dependent variable and one is an independent variable. In other way, we say that X Limited's returns are dependent on market returns. So hence market is an independent variable and X Limited is a dependent variable. So in this case, beta is summation of xy. I will explain this. N x bar y bar divided by summation of y square minus n y bar square, where x is the stock and y is the market. Okay, students. So this entire discussion is for beta. Beta is actually the sensitivity of a returns of a particular security in relation to market. Now that market, we have to study the movement of that market along with the changes in the returns that is happening for the security. Correct. So if we go by the correlation method, this is a simple formula that is used. If we go by the regression method, so in this case, we have to see the X and Y. This is the relationship where it says that beta is equal to you multiply the X and Y and take a sum of it, then minus total number of observations. N is the number of observations. X bar, Y bar. X bar, Y bar is what? The mean of returns of stock, mean of returns of market, both put together multiplied. And hence arrive at the beta. And in the denominator, if you see square of the returns of market, taking a sum of it, and then finally number of observations y bar square. Manisha is saying, yes, we can reduce the unsystematic risk through diversification. That's what I just now explained, right? Because if you diversify, if you put your investments into different industries, your risk will be reduced. Unsystematic risk will be reduced. So, Manisha, we have to assess the systematic risk, because if we don't assess the systematic risk, or let's say we don't know what is the beta, we will never come to know in our analysis that how will our security perform when the market changes. Okay. Because systematic risk is that risk that will always remain. Hence, we need to understand how much is that value. Okay. I hope this is clear. And also, if let's say I plot a simple graph here, wherein I will say that this is the risk, okay, standard deviation, and these are the number of securities. So let's say here number of security 1, 2, 3, like that. And here let's say we are going to infinity. So you will see like this kind of a graph. Okay. So whatever risk is left here, this is called as systematic risk. Sorry. And whatever got diversified here, because higher the number of securities, higher will be the diversification and lower will be the unsystematic risk. Unsystematic risk will be lower. Okay, students? Okay. So what this chart is trying to say is that you can take infinite securities also in a portfolio, but still you will have systematic risk, because you're operating in an environment which is in part of the risks. Let's come to question number 4, students. Okay. I think the beta discussion is clear. It's mostly dependent on these formulas itself. And see, students, wherever we are using R as an input into a formula, please remember we can also substitute it with covariance with some minor modifications, because R is related to covariance that we have already studied. So using those equations, we can redraft all these equations like we have done in our two portfolio, or like two securities portfolio risk, more than two securities portfolio risk. Okay. Let's come to question number 4, students. Mr. X is having 1 lakh shares of Messrs. Kanayaka Limited. The beta of the company is 1.4. Okay. Mr. Y is a financial as Mr. Y, a financial advisor, has suggested having the following portfolio. Okay, they have given the following portfolio along with the beta and percentage of holding. Market return is 12% and risk-free rate is 8%. You are required to calculate following for the present investment and suggested portfolio. Okay, we have to calculate all these things. What is the expected return based on CAPM? Capital asset pricing model, that we already know, which is beta market return. So the risk-free rate plus beta into market premium. Correct. And also, if the market goes up by 2.5%, if the market goes down by 2.5%, if the market gives negative returns of 2.5%. Okay, students. So first of all, let us calculate the probability of portfolio beta that is suggested by Mr. Y, because we have to present all these calculations for that. Okay, students. So calculation of portfolio beta. Security. Then we will put beta here. Securities are what? SKPD. SKP and D. What is the beta? 1.20, 0.75, 0.40, and 1.40. Percentage holding is how much? That is also given 10, again 10, 30, and then 50. This is totaling to 1 that we have already seen. Then weighted beta will be 10 in 0.10 into 1.2. Okay. 0.1.2, 0.075, 0.120, 0.70, and in totality, it will be 1.015. So hence the portfolio beta becomes 1.015. This is the portfolio beta, students. Then for Mr. X and Mr. Y, now we will have to calculate the respective expected returns, right? Because Mr. X has already invested with a beta in mind. Calculation of expected return. This will be based on CAPM. Okay, students. Because we have been given risk-free rate as well as the market return. What is the first company? Kanyaka. And second is the portfolio. Risk-free rate 8% in both the cases. Beta 1.4 is given, and with this we have calculated as 1.015. Market return, return of market 12. Risk premium. Students, we all know risk premium is market return minus risk-free rate of return, which is 4%. Beta into risk premium is 4% multiplied by 1.4, which is 5.6. 4 into 1.015. 4 into 1.015, which is 4.06. Correct? And then finally, expected return, which is this plus risk-free rate of return. So this is 13.6 and this is 12.06. Okay, students. So this is the as-is returns without any market going up or down. Now comes the complexity. So the first part, it is saying that the market goes up by 2.5%. So if market goes up by 2.5%, students, then we have the beta. In relation to that, can we calculate the movements? Yes. So this is the present scenario, okay? And this is the second, the proposed scenario under that first part. Okay, calculation of expected return if market goes up by 2.5%. So what is the existing market return? 12. If it goes up by 2.5, it will be 14.5 now, right? So I'm just writing the formula K for Kanyaka and P for portfolio 8% plus beta of 1.4. So this becomes 14.5 now, right? Minus 8%. So this is 17.1%. Similarly, 8% plus 1.015 14 and a half minus 8 percentage. This is equal to 14.60 percentage, students. Okay. Then let's come to the second part. Second part, it says that the market goes down by 2.5 percentage. So in this case, we will reduce the 2.5 from 12, which becomes 9.5. Again, easy and simple, right? 8% plus 1.4 is the beta. Now, 12 was the market rate. Now it has gone down by 2.5. It becomes 9.5. Similarly, the beta of portfolio was how much? 0, 1, 5, 9.5 minus 8, 10.10 and 9.52. Now, students, the third part, the third subpart of second part says that market return becomes negative 2.5%. Market returns becomes negative 2.5%. Then we just have to follow that bracket is minus 2.5 minus 8. Minus 2.5 minus 8. So this comes as minus 6.7%, and this is minus 2.66 percentage. Okay, students, I hope this is clear. This is a good combination of CAPM and beta, right? So the only trick here is that just to read the question carefully and to then interpret it. Wow, what exactly is being asked by the question. Now let's go to the last second part here. If the probability of market giving negative return is more, please advise Mr. X whether to continue the holdings of Ms. Kanyaka Limited or to buy the portfolio as suggestion of Mr. Y. So they are saying that this is more. The probability of first subpart, third subpart is more. Then what should they do? So we understand that if the probability of market giving negative returns is more, then it will be better to buy the portfolio because the beta is lesser than the portfolio beta is lesser than the Kanyaka beta. This is the first part. Okay. And first subpart, second subpart, and third subpart. That's what we have discussed. Now the second part. The second main part, if the probability of market giving negative return is more, it is advisable to Mr. X to buy the portfolio which is suggested by Mr. Y, who is the investment advisor, because beta of the portfolio is less than that of Kanyaka Limited. Students, can you please let me know if This is clear. Okay. Are there any other questions? Please do let me know. Otherwise, we will move ahead. So student, these are some good set of questions, okay? And hence we will have to take it in the sense what the question is specifically asking. Negative return means perfectly negatively correlated. No, no, Mancha. Negative return means the third subpart, which is this. Negative returns is market is itself negative. That rather than giving you a positive return of 5, 10, 15, 20%, it will give you minus 2.5%. That's what the question is saying. Okay. Let's come to next question, which is question number 5. Mr. A has short-term investments in the shares of various companies. The details of these investments is as follows. TUVW. Okay. Number of shares, geared beta, current market price, dividend yield, and the expected return also they have given. Risk-free rate and the market return are 6% and 16% respectively. So wherever this type of information is given, just see that somewhere or the other, we have to apply the capital asset pricing model. You're required to estimate the risk of Mr. A's portfolio relative to that market. See, it is not asking us to calculate the risk itself. It is asking us to calculate how much it is relative to that of the market, which means it is asking us to calculate the beta. Whether the composition of portfolio should be changed, if yes, then how? Then basis this analysis, you let us know whether there is a change in the composition required or not. Okay, perfect. So first of all, it is asking us to calculate the beta of the portfolio, correct? Because Mr. A is holding a portfolio. Calculation of Mr. A's portfolio risk relative to market. Okay, how it will be calculated? This is the name. T, U, V, and W. Beta is how much? 1.55, 0.65, 1.626, and 1.14. Okay. So the market value will be. Now, why we are calculating market value? Because we need weights. For calculating weights, we need to see what is the current market value. Number of shares multiplied by the current market price. Correct? So this is 2,80,000. Then 5,27,000. Then 3,90,000. Then lastly 4,08,500. And hence the weights will be, so that we will take a total and we will arrive at the respective weights. Okay, students? 1744, 3283, 2429, and lastly 2544. These are the weights. Beta multiplied by the weights, 2703, 2135, 3061, and lastly 0.29. So in totality, we are having how much? 1.0799. So this is the portfolio beta. So there is no rocket science in this question, right? Whatever we have done, we have just simply calculated the market value, arrived at the portfolio beta with the individual betas. Can we say that the portfolio beta rounded off is 1.08? Simple. So the risk of portfolio relative to that of a market 1.08. Okay. I hope it is clear. Other students, Shailesh, Shruti, Tanisha, Suraj, Viraj, Ambika, Kusuma, Mancha, Shruti. In case something needs to be there, please do let me know. But the concepts and questions are mostly around this. Okay, now let's come to the next part. Whether the composition of portfolio should be changed. If yes, then how? Simply they're asking us to see whether the composition needs to change or not. That we will be able to tell once we understand what is the individual returns that we are getting. Correct. So, see students, there is a return basis this beta that we know can come, and there is a expected return also that is given to us. So the return basis this beta, if we compare this expected return, then we will be able to understand what needs to be done. Okay. So this is the second part. Calculation of expected return based on CAPM. So I'm just putting down the numbers, sorry, the name of the company, TUVW. So the expected return as per CAPM will be 6% plus. What is the beta? 1.55. Market return is 16% minus risk-free rate is 6%. Okay. So basis this CAPM, what is the ER? Similarly, here it will be 6% plus beta of 0.65, 16% minus 6%. Plus beta of V limited is how much? 1.26. Beta of W limited is 1.14. 21.50 percentage, 12.50 percentage, 18.60 percentage, and 17.40 percentage. Okay, students. Now, somewhat the market return of these stocks is given as this, which is 21, 12.5, 18, and 18.5. 21, 12.5, 18.5. Sorry, it was 18, not 18.5. It was 18. And lastly, it was 18.5. Can we see what is the difference now? Because the beta related value that we can expect from the market is 21.5. The market is giving us a return of T limited at 21%. So don't you think this is a overpriced share? minus 0.5. This is okay. In this case also, our expectation is 18.6, but the market is giving only 18. So this is also a overpriced share. In this case, we are expecting only 17.4, but market is giving us 18.5. So this is a underpriced share. Sorry, this is not negative. This will be positive. Correct. Because we only expect 17.4, but market is giving us 18.5. Hence, we should buy this. We should sell this. We should also sell this, and we should hold on to this. Okay, Prashant is saying what is geared beta and ungeared beta. Very good. After a long time, some question has come. Okay, Viraj Mancha. Okay. So, Prashant, see, geared beta and ungeared beta is actually denoting the presence of debt in a company. So, if you see at a company level, they have different sources of funds, right? Something might related to equity, something might related to debt. So geared beta and ungeared beta is representative of that fact. Geared beta is where the beta is geared because of the presence of debt in that company. Okay. But although there is no distinction in the question, hence we have gone ahead with the geared beta itself. Okay. Without thinking anything else, we have gone ahead with the geared beta itself. Okay, students. So this is more to do on beta, the calculation of beta, right? How beta will be calculated, again, we have some other questions to be solved, but the relationship of beta is such that it will help you to arrive some expected part, some expected, let's say, value, which you can compare with what market is offering you. And hence you can take a decision. See, in case of you, Mansha, let's not go at an intrinsic value. Let's compare this, because intrinsic value and market value will be derived from these factors. So internally, as per the calculations, our expectation is 12.5 should be the number, but market is also giving us 12.5, and hence we are saying we need to hold on to this. Let's come to the next question. Question number 6. The following information is available for the share of X Limited and stock exchange for the last 4 years. Now, student, this is a very good question. Okay. So it has given us X Limited share price dividend index, how it has moved, returns from the market funds. That means this is a market return. Because wherever market funds are there, that means it is representative of the entire market. And these are the risk-free returns. Returns from government securities is mostly risk-free returns. Okay. Then with the above information available, please calculate expected return on X Limited's share. So first of all, they are asking us to calculate the expected return on X Limited's share. Now, if you see, we have been given present year, which is today, and 4 years ago. 1, 2, 3, 4, like that. Now, don't you feel that for calculating the expected return, we can just simply compare 0, 1, 2, 3, and 4. Correct. So here, so we are 197 here and 95 here. Correct. So we have to first calculate within 4 years what is the change in the share price, and accordingly adjust for the dividend yield to calculate the expected return. So first part, expected return on X Limited's shares. This will be calculated as annual percentage of capital gains, right? So there is a formula of constant annual growth, right? Wherein we have a value at the end of some years and value at the beginning, and we have to arrive at the constant annual growth. So that will be calculated how? 197 divided by 95. Okay. Whole raised to the power 1 by 4. Why we are doing 1 by 4? Because there are 4 years. 1, 2, 3, and 4. So these values are related in terms of the 4 year and minus 1. So this is 0.20, which is equal to 20%. So 97, sorry, 95, it will grow by 20% on a compounding basis. So at the end of 4th year, we will reach at 197. This is the simple understanding and logic. Okay, students. So 20% has gone into this. Okay. Now, if you see, we can actually prove this. 4 times if you do, we will reach at 197. Okay. Understood? So percentage annual of capital gain is 20%. Then second will be average percentage of dividend. So since we have been getting different values of dividend, 10, 12, 8, 10, 10, just to average it out, we will just take simple average. Okay. So this is equal to 10%. So the average percentage of dividend yield becomes 10%, and hence the expected return on X limited will be 20% plus 10%, which is equal to 30%. Prashant, there is a way to it. Okay. We will explain that later. Okay. Mostly in your examination, if it is raised to the power 1 by 4, you will be given some sort of a table or some sort of a hint what is that value belongs to be. If not, then yes, there is a way to calculate it on calculator. We will discuss that later. Then expected return on market index. Now students, in case of market index also, 2182 is today's value, 1490 was 4 years ago's value, and hence can we calculate the average annual percentage capital gain? Yes. Expected return on market index. Okay. So what is the expected return on market index? 2182 divided by 1490 raised to the power 1 by 4 minus 1. Simple. That is actually 10%. The same formula. Then students, also please note that actually this is return from market funds. That means these are equivalent to dividends. Okay. because these are the returns that we are getting. Let's say this dividend yield is given for X limited. So these returns are related to the stock exchange related returns. So average percentage of dividend yield, again, we will just take a simple average 16 plus 15 plus 16 plus 10 plus 18 divided by 5, which is equal to 15 percentage. And hence the expected market return, again basis the historical data, right, which is 10% plus 15% as dividend, in totality 25%. Okay. Then third part, risk free rate of return. This also we can just average out, right? Because we have been given in the last column, whatever is the risk-free rate of returns from the government securities. So this will be 15% plus 15% plus 16%, 14%, and then 15% whole divided by 5, which will make it as 15%. Okay. Now, last part of the question says that beta of X limited, simple students, beta of X limited. Now, you have market return, you have security return, you have risk-free return. Can you use CAPM? As per capital asset pricing model, return of a security is equal to risk-free return plus beta return of market minus return of security. Correct? Can we use this? So return of security was how much? It was 30%. So 30% is equal to risk-free rate was 15% plus beta, then market return was how much? 25. So this becomes 15% is equal to beta, 10%, sorry, 15%. Just a second, students. It should be 15 here. And it should be 10 here. So beta is equal to 15% divided by 10%, which is equal to 1.5. So hence beta is equal to 1.5. Okay, students. Yes, Mansha, perfect. 1.5. Yes, students. Now let us move ahead. So students, till now, if you see, we have actually gone through and understood the risk, return, beta, beta within risk, which is systematic and unsystematic. And we also said that beta is a measure of sensitivity of returns of any particular security in relation to that of a market. Correct. And we also studied that while calculating a portfolio risk, we have to also calculate the covariance or at least R between all those securities to arrive at the portfolio risk. But now we are actually covering one more important topic, which has actually made the earlier detailed calculation in a very easy manner. This is called as Sharpe's index model or single index model. Okay, see, I'll tell you. This is called as SIM. And one more thing, students, please note this topic that we have covered above. This topic, the way we are calculating risk here, this is called as Markowitz portfolio theory, MPT. So this calculation is basis MPT. Okay, students. Now, this is what Markowitz told, that we have to find out covariance R, and then we have to arrive at a portfolio risk, two securities, more than two securities, all those calculations we will have to do. But Sharp, on the other hand, had come up with a very simple and single index model. Now, what does this states for? It states that you link everything with market, whether it is your risk, whether it is your return. You don't need to calculate the variances between both of them. You just see you have a measure of degree, which is beta, right? Beta measures the changes in X limited in relation to market. So you use beta to calculate once the market changes, then how X will change. And hence, market is a single index, right? So the changes of X limited is dependent on market's changes, which is a single index. Hence, it is called as a single index model, right? So under this, so the return and risk can be calculated as using these formulas, which we are writing. So again, return, it can be due to macro and micro factors, right? So there are macro factors for which contribute for which they contribute for risk and even for return. And similarly, there are micro factors for risk and return both. What are those macro factors and what would be the return on account of that? Beta into RM, which is beta into returns from the market. Simple. And micro has two parts, alpha and EI. I will explain these things. So first of all, beta here is equal to beta of security. RM is equal to returns of market. What is alpha? Alpha is in case RM becomes zero. If RM becomes zero, then alpha is the minimum return expected from the security. Okay. So in case RM becomes negative, so this entire thing will become negative. Macro will become negative. Sorry, if RM becomes zero, the macro will become zero. Then in that case, there will be still some expectation to be there from the security to deliver, which will be denoted by alpha. Then EI is the residual return, or we can say the return on unsystematic risk. Okay. So if you see, this is a return on systematic risk. This is a return if systematic risk goes to zero. And this is a return which will be there if there is unsystematic risk, because for every risk there has to be a return. Okay, students. So this actually have led to this equation. Return on a security is equal to alpha plus beta into RM plus EI. Whenever question will ask us to, or question have given us the information on alpha or on, and along with beta, RM and EI, then we will use this equation to calculate the numbers. This is a Sharpe index model. Okay. Okay. Then let's talk about risk. Continued on next page. Now let's come to the risk. Now it said that while we have to calculate the risk will be an outcome of again two things, macro and micro. Okay, what are those macro things? Again, where beta will be used and standard deviation of market will be used. Only thing, we have to take it as a variance, because always we calculate in the form of variance, then we arrive at the standard deviation, right? So beta square into standard deviation of market square. So this you do for arriving at the systematic risk. Actually, this is called as systematic risk. Beta square into standard deviation of market square. This is called as systematic risk. And for unsystematic risk, you take the residual risk standard deviation. So the total risk will be beta squared standard deviation of market square plus residual risk here. And hence the standard deviation will be, so this is actually variance, right? The above formula is variance. To convert into standard deviation, we will just do like this. Okay, so under this method, Sharpe has actually simplified the way we look at risk and returns. What is suggested by this model is you always look from the macro and micro. Macro is always related to beta and market related standard deviation or return, and micro is always related to the residual return or residual risk. Okay. Let's go further now. So this is for the individual security. These formulas are for individual securities. Now let's come to the portfolio risk and portfolio return under SIM. Now hear me out, students, again. Okay. Now let's come to the portfolio risk and return. This is under SIM, single index model or Sharpe's index model. See, first of all, let's talk about return here. Then we will talk about risk here. Okay. See, for return, the return of a portfolio under Sharpe's index model will be given by weights of respective securities multiplied by alpha plus beta RM plus EI. Correct? So these are the security returns. These are their respective weights. Security returns by the respective weight multiplied, we will arrive at the return of the portfolio. Let's come to risk. See now, students, risk, there is no need to go in two securities and more than two securities because that was there in the Markowitz portfolio theory that we have studied earlier. In this case, the equation is very simple. It is saying that you just relate the the variance of the market through this. First, you take the macro related risk. Then you also take okay, wait, let me do a reshuffle here so that it is easier to understand. Weight of that respective observation multiplied with the beta of that respective observation. Then you multiply it with the standard deviation square. Yes, Tanisha, I will explain that. 1 till n, this will be weights multiplied by the respective standard deviation of the residual value. So students, this is the formula for a portfolio risk. So what we have to do, first we have to calculate in that portfolio the weighted beta. This is weighted beta, right? Can I call this as a systematic risk of portfolio? The entire equation, this entire first part of the equation, can we call it as a systematic risk of portfolio? Yes, correct. And this is the unsystematic risk of the portfolio. Now, students, if you see in this, there is no use of R or covariance. Correct. It is substituted by beta. And even everything is related to the market, the standard deviation of market, and that has to be multiplied with the beta. Similarly, standard residual variance in that particular portfolio multiplied by the respective weights. Now let us do a simple comparison. Here is MPT, there is SIM. Okay. MPT is all about covariance between A and B, R of A and B. Okay. Then it is matrix approach in case of more than two securities. However, it talks about SIM only has two or three things. One is beta, one is residual variance and hence residual return. That's all. So in case of SIM, everything is linked to the single index, which is market. It is nothing to do between two different securities, right? So let's say we are creating a portfolio of A, B, C. Markowitz said that you compute the relative risk and return between A, B, and C. In the Sharp index model said that you relate all these things, three things to the market to arrive at the respective returns or risks. Okay, students. So, so the objective of SIM is very clear. Sorry, it states that there is no there is no interdependency between A, B, and C. Everything is related to market, and hence you arrive at how these securities will react once the market reacts. Okay. We will try this question to understand the SIM better. I hope, Tanisha, you get the clarity. You got the clarity. And Mancha is asking, yes, sir, when the intrinsic value is greater than the market return, stock is overvalued. Sell option. No, no, Mancha. See, there is a difference. We are we are talking about, Mancha, in the previous question about not the intrinsic value. First of all, we are talking about the return generated from geared beta versus the expected return, or let's say what market is giving to us. So we cannot really apply that concept there, Mancha. Okay. Shruti is saying, can you please explain the difference between these two in more detailed manner? Yes, Shruti. Let me try. So students, see, let's say we are talking about a portfolio here. Okay. Let us talk about a portfolio of A, B, and C. There are three securities in that portfolio, or you can take n number of securities, even D for that matter. There are four securities in a portfolio. Okay. Now, all these four securities have different risks and different return profiles, right? They have return and risks profiles, which are definitely different between A, B, C, and D. Now, while forming a portfolio, we need to understand that once the portfolio is formed, what is the portfolio risk and return? The portfolio risk and return is possible to be calculated only in a one manner, which is as per MPT. I'm saying first, huh? This is I'm trying to explain MPT, Markowitz portfolio theory. It said that you have to see if A increases, how much B increases and in what direction, or decreases. Similarly, if B changes, how much C changes in what direction. You're getting my point. So they are discussing about the interdependency between all these. Then A to C, then similarly A to D, like that. Similarly B to D. We're getting my point. So how many permutations and combinations will be possible? We discussed that matrix approach, right? 4 and 4, total 16 combinations will be used to arrive at the portfolio risk. That was clear with MPT. However, in SIM, single index model, it is saying that you take all these four securities and you just see how are they behaving in relation to market. How are they behaving in relation to market? See, students, market is also a portfolio, right? Market is also a portfolio which has all the securities put together in a particular economy. So you see how A is behaving in relation to market. That is given by beta. Correct? Beta measures that changes. So you take help of beta of A and beta of B and beta of C, similarly beta of D, to arrive at the portfolio constructed risk and return. Okay, students? Okay, Shruti? So this is why it is called as a single index model. Let's come to question number 7. Sorry. Question number 7 says that a portfolio have the following features: L, M, N, and K, and the respective beta. Sorry. The random error, they are calling it as random error, but we can also call it as a residual variance or residual standard deviation in this case. Okay. This is part of the question. 7, 11, 3, and 9. Weights are also given. Analyze the risk of portfolio if standard deviation of the market index is 18%. So standard deviation of market is 18%, that has been given, and the residual variance is also given. Can we calculate the standard deviation of a portfolio? Yes, very easy. So first of all, we have to calculate the weighted beta. So portfolio, see how simple this calculation is. If let's say we would have not got the single index model, for these four, you would have applied the matrix approach and you would have obtained the 16 values. But in this case, I'll tell you how to do the calculation easily. So portfolio beta will be 1.60 into weight, plus for M it will be 1.15 into weight, plus for N it will be 1.40 into weight, and lastly 1 into 0.20. So the total comes as 1.295. This gives us the portfolio beta of this portfolio. Sorry. Then the standard deviation of the risk of the portfolio will be, it will be 1.295, which is already the weighted beta square, multiplied by the standard deviation of market square. Perfect. So this is giving us the systematic risk of the portfolio, correct? Then the individual weights multiplied with the residual risk. That's all. You will get the portfolio variance. 0.25 square into 7 square plus 0.30 square into 11 square plus 0.25 square into 3 square plus 0.20 square into 9 square. The reason why we are doing square is, as I have already told you in our previous session and in this session also, that always while calculating standard deviation, we have to arrive at the variance first. Hence, we are arriving at the variance here. Okay, so this comes as portfolio variance is actually equal to 561.115, and hence the portfolio standard deviation is equal to 23.69%, which is exactly a square root of 561.115. Perfect, Shruti and Tanisha. I hope this is clear, and rest everyone also. So students, with this, we have also covered the topic of single index model. We will definitely do a lot of questions on practicing between the topics that we have covered today earlier and even this as well. But the only point which in single index model we are trying to make it, it is a very simplified version. Okay. In the sense that you just need to use beta to arrive at the portfolio risk and portfolio return, students. Okay. So let us just spend 5 minutes in discussing and recapping what we discussed today so that we can take it up ahead from the next session. So students, we started our discussion on our portfolio management, where we discussed about the security risk and return risk being standard deviation and return being mean, where we said that historical data as well as probability related futuristic data needs to be considered. And then we explained about certain terms, which is covariance, variance, correlation coefficient, which were used to calculate the risk. Now, this was very important point where we said that this risk calculation was given under Markowitz portfolio theory, wherein the risk for two securities and more than two securities would be calculated in the manner that was explained. So more than two securities, we discussed that we either need correlation coefficient or covariance to calculate those things. Then we actually did certain questions practice to understand how do we calculate the portfolio risk, right? With the use of Markowitz portfolio theory. Then the next topic that we discussed was on beta, right? Beta being very important measure. Just a second. Yes. So here we discussed about systematic and unsystematic risk. Systematic risk, we said that beta is not equal to systematic risk, but it helps in calculating the systematic risk. And we also discussed how to calculate beta, the two different ways. Then finally, we landed onto the single index model, where we discussed about what are the implications or what are the differences between single index model compared to the Markowitz portfolio theory. In this, we said that everything is linked to the single index, which is market. And hence, even while calculating the risk and return, the market relation or the market sensitivity needs to be given preference. So yeah, I think that's all from the today's session. See,
Uh,
Ashish sir is
uh,
also there with us. I request him to give us the concluding remarks. Thank you, sir.
uh, thank you. Your session was very good. And since I was having only there was one question was student regarding saying, sir, how we can calculate the
Yes.
of any value raised to power 1/4.
Yes, sir.
So student, in this regard, please note that you can simply use your calculator by pressing 2 times square root sign. It will give value 1/4. It is not a problem. Problem comes when we have to find out the value, say 1/5, okay, 1/3, 1/7. Because if you need to calculate 1/2, no problem. Press square root sign one time. If you want to find the value 1/4, press 2 times square root sign. If you want to find the value 1/8, then again press the square root sign. But problem comes when it comes to 1/3, 1/7, 1/6. In that case, my advice to you, please leave the question as it is if no value has been given you in the question itself. Okay, don't worry, no marks will be deducted for the further answer. Okay, so because normally it comes into the mind of student, where sir, how we will calculate? If it happens, because simple generally these values cannot be calculated with the help of simple calculator. However, there are some techniques are there, but these are very long techniques. Okay, so my request to you, student, you can just leave your answer there. And Devas sir, can you please write down our phone number
Sure.
as a customer?
Sure, sir. Uh, z-
Zero
Zero
one two zero 3045
four five
956.
956.
Okay, student, you can contact us as this number. Okay, or otherwise you can send your queries as BUS mobile app. Okay, maybe because due to some official work, we are not taking up the queries within. I think by Wednesday or Thursday, we shall clear all the queries to you, of you, the students. Preferably, we will try to clear by the Tuesday or Wednesday. So, student, please do send your queries if you have any doubt. Okay, Deva sir, thanks a lot for
Sure,
sparing
sir.
your precious time and taking the session and throwing the light on the such a complicated topic that student feels like that.
Sure,
Okay,
sir.
student. Thanks to you for patience listening, and we shall continue the same topic in the next class.
Sure,
Okay,
sir.
Devas sir.
Yeah.
Okay,
Thank you,
Devas
sir.
sir. Have a
Yeah.
nice day. Okay, sir.
Thank you,
Have a
sir.
nice day.
Thank you. Thank you. Same to you, sir.
Okay. अशोक जी सेशन एंड कर
Yes,
दीजिए.
sir. हाँ जी, हाँ जी. ठीक है, सर. थैंक यू.
Thank you, Devas ji. Okay.
थैंक यू.
Session over.